Week 5, Business 630, Corporate Finance, Capital Budgeting, Risk Analysis. We'll complete our discussion of last week to go over the strategy behind risk analysis. We learned how to do it in our spreadsheet on Friday, and we practiced that this week in case number 3, a spreadsheet format case that is due Sunday, March 6th. And that has been posted, and I'll review that in just a few minutes. But we're going to finish our discussion of sensitivity and scenario analysis, the final step in a capital budget analysis to determine whether a risk in an investment of assets with capital structure funding those assets to determine the cost of capital, is it worth it? Is it worth it as far as a adequate return on the investment by the net present value, internal rate of return, profitability index, payback methods of investment return analysis? Is the cash flow budgeting providing an adequate return, what we think, to our investors? And at the same time, what is the output or scenario risk of the possibilities of not achieving or overachieving our output in units levels? And what are the key variables of the case as far as sensitivity? If they change dramatically, plus or minus, how does that affect the net present value or the return of the project? This all leads up to our Business 630 assessment case. It's called the Electrics Incorporated. It'll be posted on Friday of this week with the weekend video introducing it and talking about it this coming weekend. Next week, we're going to be talking about financial statement analysis and forecasting capital requirements, chapters 3 and 12 of our text, but just so if any of you are looking at a text, that's the chapter referral. And also we'll review the assessment case next week as well. So that's where we stand. So now let's go and look at that spreadsheet that we did on our weekend update just a couple of days ago. Now, also remember, all of you have posted your case number 2 work, which I think was probably fairly easy for most of you. Hopefully it was, which leads us into this discussion. But I will have the case number 2 grades posted by Thursday of this week, knock on wood, by Thursday of this week. And I'll send an email when those grades and solutions are posted. So with the case number 3 this week, 60% of our grade requirement for this course will be completed by the end of this week, number 5. We have 2 grades remaining. The course assessment case, the Electrics Incorporated, which is due on the last day of class, March 27th, and case number 4, which will be given in week 7, due on March 20th, case number 4. Case number 4 will be a PowerPoint format. You will put together some PowerPoint slides on financial statement analysis, mergers and acquisitions. And we'll talk more about that later. So 60% at the end of this week will have been completed grade-wise of our course. So again, picking up where we left off last week, we talked about the capital budgeting process. What does it mean? That's what our discussion of our course lecture, the video this week is. What does all this mean? Yes, I can determine the WACC. Yes, we now can determine the base case analysis to determine the cash flows based on the variety of variables given to us. Variables such as the investment in the asset, salvage or scrap value at the end of the life of the asset, depreciation per year, a non-cash expense, the output level that we estimate we can sell and produce our product over its life, the selling price per unit, the variable cost per unit, and the fixed costs per the project per year, all also increasing on an annual basis due to their specific inflation rates. The tax rate of the company, and the working capital necessary to keep the asset running during the course of the project. Put all those together and then do a discounted cash flow at our cost of capital that we calculate for this particular project, and we can determine our return on investment. In the case in this spreadsheet or template we looked at last week, it's a pretty profitable investment. And then at the end of the week, we said, okay, what if certain things change in this analysis? A scenario analysis takes a look at changing in outputs. What happens if our outputs change? How does that affect profitability? And at the same time, what if certain variables are isolated or looked at individually? What if those variables change? How does the change in those just individual variables affect the profitability or the beta rate as the return on investment of the investment? And that's what we did in the risk analysis. We put together two tables that showed us if a different scenario from our base case of a strong output level and a weak output level. And also the key things to the scenario analysis is the percentage or the probability that those will occur. We weight the probability times the net present value of those different output levels, and we get an average weighted net present value return of what's going to be the average based on the probabilities of those scenarios. And then the sensitivity analysis, taking a look at each variable individually, plus or minus a certain deviation percent from the original base case. How does that affect the NPV by selling price going down and up per unit, by variable costs going down or up per unit, and the weighted average cost of capital going down or up as a percentage rate to determine the discounted cash flow? These provide us with a risk analysis of the sensitivity. The steeper the slope of the line graph on those values indicate the more sensitive the variable is to the particular project. In other words, a greater change in selling price is a lot more significant in profit range than it is the variable cost per unit and the weighted average cost of capital line. They're flatter. They still change, but not definitely as drastic as selling price per unit, which is pretty obvious, really. But it just gives us some physical evidence that if we have to sell our product at 15% less, all else being equal, we're still going to make a profit. Not as much. And that can indicate maybe potential risk involved with selecting this investment. But if you're pretty confident that the base case is going to work, we're going to make $504,000 in net present value. That's pretty safe. But we're looking at different alternatives. That's the key. And that's an important perspective to look at as an MBA student. Not only can you crunch the numbers, but what does those change in variables, either at an output level or a sensitivity rate variable per variable, how does that affect return? Does it send up warning signals? Or in the case of this particular project, not so much. The weighted NPV based on the different changes in the probability of those happenings is only 40,000 less than our original base case. And we're still making a profit at whatever variable we choose, and the deviation in that variable, lower or higher, we're still making a hefty profit. So the risk factor in this particular project is not as great because we don't see any negatives really in the overall risk assessment. Yes, if we sell 12,500 units, we're going to lose money. But there's only a 25% probability of that happening. But if we see those warning signals in the early years of the actual numbers of the project, that can tell us certain things about maybe making some changes. Remember, this base case analysis is a projection, but also it's a template for variance analysis. This is what we think is going to happen. And then as the actual numbers come at the end of year 1, year 2, and year 3, if those actual numbers deviate dramatically from our projections, either in output or sales or in our costs, then we as managers can make adjustments to strategy. A perfect example of that is the pandemic. 2 years ago, before the pandemic, companies were making a lot of profits. They were meeting their sales figure. Yes, the inflation rate was still a little bit on the horizon, which was bothering some people, but it wasn't happening yet. And we were all companies were doing well. But then into the pandemic of 2020 and 2021, revenues dramatically dropped. Well, how did companies fix that? Looking at their analytical sheets like a budget. Well, they first of all cut costs. They laid off people. They found different alternatives to expenses, different types of vendors, maybe laying off salaried people and hiring temp people. They changed their strategies to maintain a pretty well semblance of profit, but the pandemic urged them to make changes. And then as the pandemic was winding down, supply chain issues of in the last year. Geez, we can't depend on our vendors in Canada or China or South America anymore. We have to go to different vendors. Usually when you go to different vendors, it's going to cost you more. Or if we want to stick with the same vendors and with the supply chain issue of ships being stuck out in LA Harbor, maybe we should fly our product or our goods into the country instead of by shipping them, naturally increasing the cost of those products. So the supply chain gave us issues, or gave companies a variety of issues. And they worked around that by keeping their people costs, their labor costs down, and they're still down. Labor costs are beginning to come back up, but far from it. And what's hurting labor costs right now is in the inflation rate. Well, maybe we shouldn't hire back those people because we're going to have to pay them more. Let's see if we can continue the post-pandemic labor rate or labor use of our businesses. Instead of, if I'm a manufacturing company, let's run 2 shifts instead of 3. If I'm a retail company, let's keep with the reduced labor force to try to sell our product and maybe shift to a more online source of revenue where it requires less people and more technology, more fixed costs than variable costs. So again, these are all things that this discussion, this risk analysis leads to is, are we prepared for changes down the road of a particular investment? Are we prepared if things alter, good or bad? As MBA managers, that's the strategy you have to be aware of. That's what you have to look out for. When you get monthly reports comparing your base analysis plan to the actual numbers, where do you see potential problems and trouble? And that's what you're going to look at in the assessment case. I'm going to give you a base case, and then I'm going to give you actual numbers. Where do you see potential problems in that case as a manager, as a strategist? What's going on in a 20-year project or a 7-year project or a 10-year project? What's occurring that you see going through year 4 of actuals? Do you see any trends compared to what your plans are? So that's what this is all leading to get an idea that what the numbers represent and how you use them to look at situations where your investment, your return is going to be threatened. That's why many companies use a SWOT analysis, and you've used one already, many of you, in our casework. What are the strengths and opportunity of this investment? What are the strengths and opportunity of this $1 million investment? But at the same time, what are the weaknesses and the threats of this investment. The weaknesses could be, well, in order for us to meet that 25,000 unit plan, we might have to lower our retail price. Or, geez, we got a labor contract coming. What happens if our labor costs go up? Or what happens if the inflation rate raises or increases the cost of capital? How are those weaknesses or threats affecting the bottom line of our investment in this particular asset, in this particular market? That's what you're going to be doing later on in this course, of assessing that, interpreting it, and writing about it. Remember, the case assessment paper is a combination of spreadsheet analysis and a APA format paper. So these are things that we begin to think about. And these are the things that I want you to practice in case number 3 this week. Many of you probably have already looked at this case, but it's very similar to the template we did at the end of last week that you have to use. The only different is a few things. The length of the project is a little bit different. It's 7 years instead of 10. The inflation rates are a little different. And naturally, the costs are a little different. And also, you have the scenario and sensitivity analysis with different percentages, I might add. So remember, if you're using that template that I gave you, make sure you account for in your analysis these changes in this case. The tax rate is 20%, not 30%. So make sure you pay attention to those variables when you're updating your templates. So you're asked to determine the NPV, the internal rate of return, the profitability index, and the payback of this investment of $700,000 over 7 years. You are to determine the cost of capital, to determine your discount rate, with a debt to assets of 70% as the capital structure. The interest rate on the debt is 6.5%. The risk-free interest rate is 1.65%, and the market premium rate is 8.5%. This company's beta is a little risky, 1.3. So what's their cost of capital? You practice that in case number 2. Then we put together the spreadsheet analysis with these variables. Depreciation is $100,000 a year for 7 years, plus a salvage value at the end of its life of 7 years of $55,000 coming in the final year of the investment. The working capital base of annual sales is 8%. The inflation rate for selling price is 2%, but for variable cost and fixed cost, it's 1.5%. We're going to sell 40,000 units a year with our project tax rate of 20%. Our selling price in the first year is $45. Our fixed costs in the first year are $75,000, and our manufacturing costs or variable costs in the first year are $35 per unit. Based on this information, what is its base case returns of NPV, IRR, profitability, and payback? Once you get that spreadsheet done, then you just create another tab in your spreadsheet and do the risk analysis, just like we did in the template. The scenario analysis is based on the base case with a 55% probability of 40,000 units a year. The best case scenario, 20% probability of 48,000 units, and a worst case scenario with a probability of 25%, 32,000 units. And then your percent changes of 3 key variables: selling price per unit, variable cost per unit, and fixed cost are plus or minus 10, 20, and 30. How does the risk analysis affect net present value? Show your calculations. Just show those tables, construct those tables like we did in our sample of last weekend. You don't have to show me the graph if you don't want to. Do not worry about the graph. But I need to see those tables of the different net present values of those different changes in scenarios and sensitivity. And then once you're all done with this, you've completed the base case analysis and the return on investment. You've completed the scenario and sensitivity analysis and show those NPVs. I want you to just do one written answer on your spreadsheet. In your opinion, is this an investment you would approve as an investment for this company? A simple yes or no will be a sufficient answer. That's all you got to do. Yes or no. Yes, Mr. Hasty, based on this overall analysis, I think this would be a good investment. You don't have to tell me the reason why. We'll talk about that next week. And that'll be part of your part of your course assessment paper, is to tell me the reason why you said yes. But in this case, all you have to do is say yes or no. No, Mr. Hasty, I don't think this would be a good investment. That's all I want, yes or no. But forget to put yes or no, you lose 10 points off the case grade. So don't forget that simple interpretation. So this is basically a number crunching case to make sure we're up to speed of doing all this analysis. So we will have a review session, our usual Thursday night review on Thursday evening of this coming week. I also will have a weekend update video where I'll be talking about the course assessment paper that will be posted at the end of the week. So again, spreadsheet format, not PDF, spreadsheet. I want to see your formulas. I want to see your calculations in the cells, just like it's shown in our sample template we went over last week and looked at tonight. Set it up that way, no problemo, and then we go from there. So that's case study number 3 this week for 20% of your course grade, due next Sunday. So you can start with the template we gave you, modify that accordingly to the problem here. And as I said earlier, please note the different variables, because many times students submit case number 3 and have many of the same variables from our template, and they get it wrong because those variables are not a part of this case. Calculate the cost of capital, do the base case analysis, do the scenario and sensitivity analysis, and then tell me yes or no on approval. That's our work this week in week number 5. Any questions, be sure to let me know. Have a great week, everybody, and perhaps I'll see you on Thursday. Have a great week. Be safe.